Hello, welcome to Capital Sensei. Today we're going to dive deep into one of the most important investment books you might not have read. Big Mistakes, The Best Investors and Their Worst Investments by Michael Batnick. We'll explore the catastrophic errors made by legendary figures like Benjamin Graham, Warren Buffett, and even brilliant speculators like Jesse Livermore. This isn't about pointing fingers. It's about understanding that even the gods of finance are human, and their failures offer us the most valuable lessons for protecting and growing our own money. Whenever we can, we answer questions in the comments. Learning about investing is a journey, and hearing about real-world experiences, both successes and failures, is incredibly valuable for everyone. So please, feel free to comment with your questions. Share a mistake you learned from, or just tell us your thoughts. It helps us build a community where we can all learn from each other. The central idea of Michael Batnick's book is both terrifying and liberating. Everyone, and I mean everyone, makes huge mistakes in investing. The difference between the legends who build generational wealth and those who flame out is not that the legends are perfect. The difference is that they learn from their mistakes. They structure their finances to survive their mistakes, and they never, ever make a mistake so big that it takes them out of the game for good. Think of it like this. Becoming a great investor isn't like becoming a perfect scoring gymnast. It's more like becoming a seasoned sailor. A seasoned sailor isn't someone who has never encountered a storm. They're someone who has been through dozens of them, knows how to read the sky, how to reef the sails, and most importantly, how to keep the ship afloat when the waves are crashing over the deck. The goal isn't to find a perpetually calm sea. It's to become a master of navigating the inevitable storms. Let's start with the teacher of the master himself, Benjamin Graham. Graham is widely known as the father of value investing and was Warren Buffett's mentor at Columbia University. He literally wrote the book on security analysis. You'd think a man like this would be immune to devastating loss, right? Wrong. In the lead-up to the great crash of 1929, Graham was a young, brilliant, and very successful money manager. He was so successful that he started using a tool that has destroyed more fortunes than anything else: leverage. Leverage simply means using borrowed money to invest. If you have $10,000 and you borrow another $10,000, you now control $20,000 worth of assets. If your investments go up by 10%, you've made $2,000 on your original $10,000. A 20% return. Fantastic. But what if they go down by 50%? Your $20,000 is now worth $10,000. You still owe the $10,000 you borrowed, which means your original capital, your entire $10,000, has been completely wiped out. You're at zero. This is exactly what happened to Graham. The market crash was so severe and prolonged that it didn't matter how cheap he thought his stocks were. The forced selling that comes with a margin call. When your broker demands you put up more money or they sell your stocks at the worst possible time, wiped him out. He lost nearly 70% of his capital. It was a brutal, soul-crushing experience. But this is where the lesson comes in. This failure didn't just teach Graham a lesson, it forged his entire philosophy. From the ashes of that failure, he developed his core principle, the margin of safety. He vowed to never again be at the mercy of the market's madness or a lender's phone call. The margin of safety is a simple but profound idea. It means only buying an asset when its market price is significantly below your estimation of its intrinsic value. It's like a structural engineer designing a bridge. If the bridge needs to hold 10 tons, the engineer doesn't design it to hold exactly 10 tons. They design it to hold 30 or 40 tons. That massive buffer, that's the margin of safety. It protects you from miscalculations, bad luck, and unforeseen events. Graham's biggest mistake became the bedrock of his greatest contribution to the world of investing. Now let's look at a completely different kind of operator, Jesse Livermore. Livermore was a speculator, a trader, not a long-term investor like Graham. And he was, for a time, one of the most successful traders who ever lived. He was a legend on Wall Street in the early 20th century, famous for making and losing several multi-million-dollar fortunes. His most legendary trade was shorting the market before the 1929 crash, a move that personally netted him the equivalent of over $1.5 billion in today's money. Livermore's story is a powerful lesson in the dangers of ego and an inability to adapt. He believed he had a sixth sense for the market's rhythm. After his huge 1929 win, he became convinced he was invincible. He continued to make enormous, highly leveraged bets just as he had always done. But the market environment after the crash was different. The rules of the game had changed. Livermore failed to adapt. He kept trying to run the same play that had worked before, but the defense was no longer the same. His biggest mistake wasn't a single bad trade. It was a character flaw. It was hubris. He lost his entire fortune and then some, ending up deep in debt. He couldn't handle the fall from grace, the psychological blow of no longer being the boy plunger, the king of Wall Street. His story is a chilling reminder that the market has no memory of your past successes. It doesn't care how smart you are or how much you made on your last trade. If you let your ego convince you that you can't be wrong, you will eventually make a mistake so large that it ends your career. It's like a poker player who wins a huge pot and then thinks they can go all in on every single hand. Sooner or later, the cards will turn against you and you'll be walking away from the table with empty pockets. Of course, we have to talk about Warren Buffett. People see him as the infallible Oracle of Omaha, but Batnick's book highlights a crucial mistake that Buffett himself calls a multi-billion-dollar blunder. It wasn't buying a stock that went down, it was buying an entire company that went to zero. In 1993, Berkshire Hathaway bought a shoe company called Dexter Shoe. At the time, it seemed like a good business with a strong brand and a durable competitive advantage. Buffett was so confident that he paid $433 million for the company. But here's the critical part of the mistake. He didn't pay with cash. He paid with Berkshire Hathaway stock. Shortly after the purchase, Dexter's competitive advantage evaporated. Cheaper shoes from overseas competitors flooded the market, and Dexter's business collapsed, eventually becoming worthless. So, Buffett essentially traded a wonderful asset, Berkshire stock, for a worthless one. The real pain of this mistake is the opportunity cost. Buffett himself has calculated that the Berkshire stock he gave away would be worth well over $10 billion today. Think about that. He didn't just lose $433 million. He lost all the future growth that stock would have generated. This is a next-level lesson for investors. A mistake isn't just about the money that leaves your account. It's also about the potential gains you forfeit. It's a reminder that how you pay for an asset is just as important as what you pay for it. Using your own high-quality stock as currency is like trading a Michael Jordan rookie card for a lottery ticket. The ticket might win, but you just gave up a guaranteed Hall of Famer. Let's not forget Buffett's indispensable partner, Charlie Munger. Munger is known for his sharp wit and his focus on rationality and avoiding stupidity. But he, too, learned a powerful lesson from a big mistake early in his career. Just like Graham, Munger got bit by the leverage bug. In the early 1970s, he ran his own investment partnership, and feeling confident, he used a healthy dose of borrowed money. Then came the brutal bear market of 1973 to 1974. one of the worst in modern history. The market fell by nearly 50%. Munger's leveraged portfolio got absolutely crushed. He faced a gut-wrenching decline of more than 50% in a single year. He described the psychological pain as immense. While he managed to survive and not get wiped out completely, the experience scarred him permanently. It taught him firsthand the sheer terror of leverage when markets turn against you. This is why, for the rest of his career, Munger has been one of the most vocal critics of using leverage for common investors. He understands that it turns investing from a positive-sum game of owning businesses into a negative-sum game of Russian roulette. The lesson here reinforces what we learned from Graham. Leverage is the one thing that can force a permanent loss of capital on an otherwise temporary market decline. It takes the decision out of your hands and gives it to your broker. Another fascinating case from the book is John Maynard Keynes. We know Keynes as one of the most influential economists of all time. His ideas fundamentally shaped modern macroeconomics. But he was also an active investor, managing the endowment for King's College, Cambridge. And initially, he was not very good at it. His first approach was what you might expect from a brilliant macroeconomist. He tried to be a top-down speculator. He would analyze global economic trends, currency fluctuations, and commodity prices, and then make big bets based on his forecasts. The problem is, predicting the entire economy is incredibly difficult, even for a genius like Keynes. He suffered some very large losses trying to time the market and predict macro events. It just wasn't working. The fascinating part is what he did next. He didn't double down. He completely changed his strategy. He admitted his initial approach was flawed. He pivoted from being a macro trader to being a micro investor. He started focusing on buying shares in a small number of individual companies that he believed were well managed and had excellent long-term prospects, and he held them for the long haul. His results improved dramatically. The lesson? Being a brilliant economist does not automatically make you a brilliant investor. The two skills are different. Knowing how the weather system works in general doesn't tell you exactly where lightning will strike. Sometimes, it's more profitable to ignore the storm clouds and just focus on finding the sturdiest, best-built houses on the block. Now, for one of the most famous and terrifying blow-ups in financial history. Long-term capital management, or LTCM. This was a hedge fund, started in 1994 by a dream team of financial wizards. It included John Meriwether, a legendary bond trader from Salomon Brothers, and two Nobel Prize-winning economists, Myron Scholes and Robert C. Merton. These guys created the Black-Scholes model, a foundational tool for pricing options. They were, without exaggeration, considered the smartest guys in the room. Their strategy was to use complex computer models to find tiny pricing discrepancies in global bond markets, and then use enormous amounts of leverage to turn those tiny profits into huge ones. They believed their models had essentially eliminated risk. They were so confident that for every $1 of their own capital, they were borrowing and investing more than $25. The leverage was astronomical. For a few years, it worked like a charm, and they generated incredible returns. But their models were built on historical data and assumed that markets would always behave within certain statistical bounds. In 1998, Russia defaulted on its government debt. This was a black swan event, an event that was considered so unlikely by their models that it was statistically impossible. It was a 6 sigma event, something that should happen once every few million years. But it happened. This single event caused a chain reaction. Investors all over the world panicked and fled to the safest assets, causing the pricing discrepancies LTCM was betting on to widen dramatically instead of closing. With their massive leverage, their losses mounted at a terrifying speed. In a matter of weeks, the fund lost over $4.6 billion and was on the verge of collapse. The situation was so dire that the Federal Reserve had to orchestrate a bailout from a consortium of Wall Street banks to prevent the fund's failure from triggering a global financial meltdown. The lesson from LTCM is perhaps the most important in the entire book. Financial models are not reality. The real world is infinitely more complex, chaotic, and subject to human panic than any spreadsheet can capture. Believing you have a system that can't fail is the surest way to engineer a spectacular failure. It's like building an unsinkable ship. Pride comes before the fall, and in finance, the bigger the pride, the more leverage is involved, and the more catastrophic the iceberg collision will be. Batnick also includes a wonderful, non-traditional example: the great American author Mark Twain. Twain was a brilliant writer, but a truly awful investor and businessman. His biggest mistake was his obsession with a machine called the page compositor. It was an incredibly complex typesetting machine, a mechanical marvel with over 18,000 parts designed to automate the setting of newspaper print. Twain became infatuated with the invention and its inventor. He believed it would make him richer than all his books combined. He poured his entire fortune and his wife's inheritance into the project over many years. He was blinded by the story, the sheer elegance of the technology. He ignored the practical realities. The machine was too complex, prone to breaking down, and incredibly expensive to produce. While Twain was sinking all his money into this beautiful but flawed machine, a simpler, more practical invention called the linotype machine came to market. It did the same job, just less elegantly, but it was far more reliable and cheaper. The linotype machine made the page compositor obsolete before it even had a chance to be sold. Twain was financially ruined and had to go on a worldwide speaking tour to pay off his debts. His mistake was falling in love with a narrative. It's a classic behavioral pitfall. We get so caught up in a good story, a revolutionary technology, a visionary founder, that we forget to ask the hard, boring questions. Is this a viable business? Is it cost-effective? Is there a simpler competitor that will eat its lunch? For a more modern example, let's look at the hedge fund manager Bill Ackman and his infamous investment in Valeant Pharmaceuticals. In the mid-2010s, Ackman made a massive, highly concentrated bet on Valeant. He believed its business model was genius. Valeant's strategy was to acquire other drug companies, slash their research and development budgets to nothing, and then jack up the prices of their newly acquired drugs by hundreds or even thousands of %. Ackman became Valeant's biggest and most vocal champion. He went on television, he gave multi-hour presentations. He publicly defended the company and its CEO. His fund, Pershing Square, had a huge portion of its assets tied up in this one stock. This is a prime example of confirmation bias. Ackman was so convinced he was right that he likely filtered out any information that contradicted his thesis. But the business model was built on a house of cards. The massive debt used for acquisitions and the predatory price gouging eventually attracted intense media and regulatory scrutiny. The model unraveled, the public was outraged, and the stock price collapsed by more than 90%. Ackman's fund lost billions of dollars. The mistake here is multi-layered. It's about overconcentration, but it's also about ego and public commitment. When you nail your flag to the mast so publicly, it becomes incredibly difficult to admit you were wrong. Your personal reputation gets tied to the investment, making it almost impossible to sell and cut your losses, even when all the evidence says you should. So, after hearing all these horror stories from some of the brightest minds in history, what can we as everyday investors actually learn? The mistakes aren't just a random collection of bad luck. They fall into clear, predictable patterns. And most of them are rooted in human psychology. Our brains, which evolved to survive on the savannah, are simply not well wired for the modern financial markets. We are prone to overconfidence, just like Jesse Livermore and the geniuses at LTCM. When things are going well, we start to think we're smarter than we are, and we take on more risk than we should. We are susceptible to confirmation bias, like Bill Ackman, actively seeking out information that supports our beliefs and ignoring evidence that we might be wrong. We fall for the narrative fallacy, like Mark Twain, getting so swept up in a good story that we forget to check the numbers. And through it all run the twin emotional currents of fear and greed. Greed makes us chase hot stocks at their peak, and fear makes us panic sell good assets during a market downturn, locking in losses at the worst possible moment. Recognizing these biases in ourselves is the first and most important step toward not letting them control our financial decisions. If there's one technical mistake that links many of these stories, from Graham to Munger to LTCM, it's the misuse of leverage. Leverage is a double-edged sword, but its bad edge is infinitely sharper than its good one. It's the one thing that can guarantee permanent ruin. Without leverage, a bad investment is just a loss. With leverage, a bad investment can be a catastrophe that bankrupts you. It takes a recoverable error and makes it fatal. A smart investor's primary goal should be to stay in the game, and avoiding leverage is a key rule for ensuring you can always play another round. So what's the antidote? How do we protect ourselves from our own flawed brains and the market's inherent chaos? The solution lies in two key concepts: diversification and having a sound process. Diversification is the old, boring advice that you've heard 1,000 times. Don't put all your eggs in one basket. It's boring because it works. The reason Warren Buffett survived the Dexter Shoe disaster and Bill Ackman survived the Valeant collapse is that it was just one position in a larger portfolio. By spreading your investments across many different uncorrelated assets, you ensure that no single mistake, no matter how bad, can sink your entire ship. Even more important is focusing on your process rather than on individual outcomes. In investing, you can make a great, well-reasoned decision that ends up losing money due to bad luck. Conversely, you can make a terrible, speculative gamble and get lucky. The novice investor focuses on the outcome. The professional focuses on the process. A good process is a set of rules and a philosophy that you stick to through thick and thin. It governs how you research an investment, when you buy, how much you buy, and when you sell. Think of it like a professional poker player. They don't judge themselves on whether they won or lost a single hand. They judge themselves on whether they played the hand correctly based on the odds and the information they had. They know that if they consistently make good decisions, they will come out ahead over the long run, even if they lose a few big pots along the way. Your investment strategy should be your process. It's what protects you from emotional, impulsive decisions in the heat of the moment. Ultimately, the powerful, overarching message of big mistakes is one of profound humility. Investing is a field where intelligence and success can beget an arrogance that leads directly to failure. The market is the great humbler. It will humble the Nobel laureates, the legendary traders, and the brilliant economists. By studying their failures, We get to learn their hard-won lessons at a fraction of the cost. We learn that survival is the name of the game. The goal is not to be right all the time. The goal is to build a portfolio and a mindset that allows you to be wrong, sometimes spectacularly wrong, and still live to invest another day. Approaching the market with that humility, with the knowledge that even the best can fall, is the first and most crucial step toward achieving your own long-term financial success.